There's something keeping economists, investors, tech leaders, and AI observers up at night. Whether we're living through the biggest economic bubble since the dot-com crash or not. And if we are, what happens when it pops? Right now, tech companies are projected to spend around $400 billion this year on AI infrastructure. To put that in perspective, that's more than the Apollo program cost to put humans on the moon, even when adjusted for inflation. Except we're not doing this once every decade. We're doing it every 10 months. Companies are collectively funding a moon mission every year, and they're doing it to build data centers full of chips that might be obsolete in 3 years. Here's where it gets really weird. American consumers spend only $12 billion a year on AI services. That's the GDP of Somalia. Meanwhile, total AI capital expenditures are projected to exceed $500 billion in 2026 and 2027. That's roughly the annual GDP of Singapore. What's the difference between Singapore and Somalia? Basically, the chasm between hope and reality in the AI world right now. And yet, by their own admission, these companies are just going to keep spending anyway. Meta, Google, Amazon, Microsoft, they're all in an arms race, pouring money into GPUs, cooling systems, and massive data centers, even though the math isn't adding up. Some reports show that AI usage is actually declining at large companies that are still trying to figure out how these tools can actually save them money. Here's Exhibit A on the absurdity of the situation. Thinking Machines Lab, an AI startup founded by former OpenAI executive Mira Murati, just raised the largest seed round in history, $2 billion at a $12 billion valuation. But the company didn't release a product, let alone barely announce one, until 8 months after the company was launched. Before then, they didn't even tell investors what they were trying to build. One investor who met with Murati described it as the most absurd pitch meeting they'd ever attended. Murati essentially told everyone, "We're doing an AI company with the best AI people, but we can't answer any questions." And somehow this company is now worth $12 billion. This is the kind of thing that makes you wonder if everyone has lost their minds. Every financial bubble has these moments where, looking back, people think, how did anyone miss the signs? We're living through those moments right now, except we can't see it yet because we're inside the bubble. The comparisons to past bubbles are striking. In the 1800s, railways were supposed to transform civilization, and they did eventually. But first, there was a massive bubble where tracks were laid in places that could never sustain commerce. In the 1990s, telecoms promised a wired utopia. Companies laid 70 million miles of fiber optic cable, much of it still sitting dark underground, unused. The dot-com boom gave us visions of a new economy, and much of that vision did materialize, but not before valuations evaporated and wiped out trillions in wealth. Here's what's particularly concerning about the AI bubble. It's not just affecting tech companies, it's warping the entire economy. In the first half of 2025, data center-related spending accounted for half of GDP growth in the US. That's right, half. This creates a dangerous feedback loop. If you're a large private equity firm controlling hundreds of billions of dollars, there's no reward for investing anywhere except data centers. The returns look incredible because everyone's piling into AI. So all the capital in the economy gets sucked into this one sector, like a black hole. This exact same thing happened in the 90s with telecom, and it starved American manufacturers of capital, making it harder for them to compete with China. We're doing it again. President Trump is trying to bring manufacturing back with tariffs, but we're simultaneously making it nearly impossible for manufacturers to raise capital because all the money's going to AI. The financial engineering happening behind the scenes is even more troubling. The big AI companies are using accounting tricks to depress their reported infrastructure spending, which inflates their profits on paper. They're also shifting huge amounts of spending off their books into special purpose vehicles that hide the true cost of the AI build-out. This is the same kind of financial wizardry we saw with collateralized debt obligations and subprime mortgages before the housing crash. Now, some people will tell you this isn't a bubble because AI is real infrastructure that will change the world. And they're right that AI is real and transformative, but that doesn't mean it's not a bubble. Railroads were real and transformed civilization. The internet was real and changed everything. But both went through massive bubbles first, crashes second, and then eventually delivered on their promise years later. In that vein, Jeff Bezos has said that we're in an AI bubble, but eventually the gains will be so massive that they'll offset the short-term negative consequences. OpenAI CEO Sam Altman floated the idea last year that AI might require $7 trillion in investment. At the time, people thought he was crazy. Now investors aren't laughing. They're wondering if he was right. But here's the thing, even if AI eventually justifies that investment, it doesn't mean we won't have a devastating crash first. What makes AI particularly dangerous is how concentrated and how large the spending is. Most of this money is flowing to a very narrow set of recipients in very specific geographies, like Northern Virginia, which has the highest concentration of data centers in the country. When you have that much capital concentrated in one place, the potential for disruption is enormous, and the problem compounds because GPUs depreciate incredibly fast. A railroad track could last decades. Fiber optic cable late in the 90s still carries traffic today, but GPUs have a useful life of maybe 3 years for frontier applications before they are obsolete. This means the system has to earn its money back incredibly quickly, which puts even more pressure on finding revenue that currently doesn't exist. If this bubble pops, and many signs suggest it might, the consequences will ripple through the entire economy. It won't just be tech companies and Silicon Valley investors who suffer. When half your GDP growth is coming from one sector and that sector collapses, you're looking at a potential recession. We could see massive layoffs, not just in tech, but in all the industries that service data centers, energy companies, construction firms, chip manufacturers. They're all betting big on continued AI growth. So where does this leave us? Are we in a bubble? Based on historical patterns, the signs are flashing red. Massive spending disconnected from revenue, absurd valuations for companies without products, financial engineering to hide the true costs, a single sector dominating GDP growth, momentum-based investing where people buy because they think everyone else is buying. These are all classic bubble indicators. But here's the paradox. Even if we're in a bubble, that doesn't mean AI isn't revolutionary. It just means we're getting ahead of ourselves. The railroads changed the world, but many railroad companies went bankrupt first. The internet transformed civilization, but most .com companies failed. So AI will likely follow the same pattern. Rise first, crash second, eventually change everything. The question isn't whether AI is real or important. It's whether we're building infrastructure faster than we can find uses for it. And right now, the answer seems pretty clear. We're not just approaching a bubble, we're already inside it. The only question is when it pops, and how bad the crash will be when it does. Do you agree, or are those claiming we're in a bubble thinking in the past? Drop a comment below and don't forget to subscribe for more AI insights.